Well, have you ever thought about borrowing against your house? This is what we talked about today. Mortgage consultant Mark Pfeiffer, who comes on once a month, was on the program with me today. We're talking about the ins and outs of borrowing against the equity in your home. Today, there's record amounts of equity as a whole in people's homes, and you can really do some good things. Of course, you can also make some mistakes by doing this, which you want to be careful about as well. But Mark goes through the pros and the cons of that today, and I think it'll be, if you've been thinking about it or considering it, especially if you have high interest rate debt, it could definitely make sense. So just take a listen to what Mark has to say. If you need anything from me, you need to schedule a phone call, need some help with anything from a financial standpoint, you are welcome to go to info@prudentmoney.com or bob@prudentmoney.com. Send us an email, and I'm happy to do whatever we need to help you out. Hope you enjoy the program.
This is Bible School Radio, KDKR, Decatur, Dallas, Fort Worth, KYJC, Commerce, and KMWC, Bethany. On the web at kdkr.org and on all your devices with the Live 365 app. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, have you ever thought about borrowing against your house? Today we're going to take a look. Stay tuned for Prudent Money. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, have you ever considered borrowing against your house? Maybe a little hesitant. Mark Pfeiffer's here today to break down the pros and cons. Mark, always good to talk to you.
Thank you, Mr. Bob. Always good to be here.
Let's wouldn't be right if we didn't start out with a little bit of real estate market and talk get a little update. The way I see it, looking from the outside in to your world, is it seems like everything's just kind of going, 1 week it's up, 1 week it's down, 1 week it's up. It doesn't seem like a consistent trend quite yet.
No, it's not in the trend. The trend is sideways. It's gotten a little better over the last few weeks, but you're right. For a lot of what we've seen the last handful of months, it's been in this little range. And the good news is it's been a relatively normal range. September rates came down last September, then they kind of went back up a little bit. And they've kind of just hovered in that, call it high 6%. So it's that 6.5 to 7 range. They've kind of been, closer to the 7 than the 6.5, but they've been kind of in that range and not a lot of activity. Hopefully the trend will start being the second half of this year where rates do trend down a little bit. And, good Lord willing, maybe we'll see some rates in the low 6s, low to mid 6s by the end of the year. I think mid 6 is probably, my personal target, but there's talking heads. I think we can see rates in the low 6s at the year end, but we shall see. We shall see.
So do you think that people are kind of just coming to the realization this is as good as it gets and might as well just figure out how to work within the boundaries of what's out there? Or what do you...
Yeah, I think 6.5 is a good number. I'm just making that up in terms of just realistically speaking. I mean, it's not the 8% that we saw a year and a half ago. It's certainly not the 3s that we had the wonderful pleasure of during COVID. But the reality is, historically, rates are somewhere between 6 and 8%. You just kind of take the history over time, and we're talking, a century for better or for worse, as far as how long rates and where rates have been. 6 to 8 is kind of the range, and if we can be in that 6.5, I think that's, I'll take that. Certainly, that's better than 7.5 or 8. But I don't think that there's going to be, again, barring any major, black swan type events. I just don't see any real reason why rates need to get down too far into the 5s. Just based on history, I think 6.5 is a really good rate. So I personally, I'll take it. Could it be better? Sure. Could it be worse? Absolutely, it could be worse. So I'll take mid to high 6s. I think it's a good opportunity for a lot of folks to be in the market. And again, I think it's a good opportunity where things are just, I'll take steady over just wildly inconsistent from a rate standpoint.
Oh, definitely. So what is the highest rate that you've ever paid on a personal mortgage? Mine's 8.25%.
Yeah. So mine was 6.75 back in 2006 time period, give or take.
Yeah, it was
2000,
probably about
yeah.
10 years before that. But yeah, 8 and
Yeah.
a quarter. And then, what's funny is that if you remember, the rates fell for so long. And I ended up getting a 2.5. I ended up down at 2.5% at one point.
That's wild.
And you always thought it was going to be over with.
Somebody,
You always thought.
today at lunch.
Go ahead.
Yeah, somebody today asked at lunch, like, what about rates? What do you tell people in there? I said, well, I don't know about you, but I got plenty of people I can point to that bought rates when rates were at 16%. They were happy to get it.
Yeah, right, exactly.
So it's all perspective, right? It's all
Yes,
relative.
sir, it is. Well, you can borrowing against your home can be a great option. We're going to talk a lot about why, some reasons why you would do it. But it seems like people get a little hesitant when they start looking into it. And maybe the fear of putting their house in a situation where they feel like they could lose it. What do you say to someone with that type of hesitancy?
Yeah, I think it depends on what the need is, right? There's not a blanket answer that says somebody should or shouldn't. But I think the real fear, in my opinion, in addition to the just can I afford this debt, right? Your fear is real, but it's certainly the extreme. Like, can I afford it? Am I going to lose this house? I think the other one that's pretty valid is I don't want to finance whatever I'm doing for the next however long, however many years.
Sure.
So we see that a lot. Like if somebody calls, because there's a lot of reasons to tap into the equity, right? Whether it's debt consolidation to pay off some bad credit card debt, maybe it's a remodel, maybe it's to help send a kid to college or private school or whatever. There's a litany of reasons, and I think the big concern, like you said, one is can I afford it, because that is new debt, but a lot of times it is replacing old debt. But the other piece is I just don't want to finance it for 30 years, and there are solutions to that. And you don't have to. There's certainly options where you can pay more on it, and there's strategy around that. But I think that's probably the two biggest concerns is, and not to mention the mental piece, right? There's no data to support this, but the reality is I can understand the feeling of, hey, I'm going backwards, right? I've been paying on this mortgage. I've paid down the balance. I've gotten all this equity. Like, it's just kind of something of that little bit of a mental shock that says, oh, I'm suddenly going backwards. But I think for the right reasons, there's real opportunities, and it can be a fabulous tool to explore and at least see if there's an opportunity to where it makes sense for you.
Well, and I think that the key is for people to get an education. So we're going to start at the very beginning of this. What are the different types of home equity loans that are available?
Yeah, so if somebody taps into their equity, it's really for, let's start with the two big things, right? It's either going to be one of the two typically. It's going to be a home equity, which means you're tapping cash or equity of some sort to do something with it, or home improvement. So today we're focused on the home equity piece. Even though home improvement, you could talk about home equity because you're tapping that, but the reality is that's a pretty obvious what you're doing with the money. You're using it to remodel, rehab, or do something. So those are the two splits. But in terms of the home equity portion, like if it's a home equity loan, somebody's getting the cash, there's really about three different ways let's just say two different ways. You can get it to where it's a fixed rate, kind of a normal, principal, air quotes here, normal mortgage where it's principal and interest, or you can do what's called a line of credit where it becomes a variable line, like your credit card, that's attached to your home. So those are primarily the three ways if you want to count the home improvement loan, but those are the two home equity kind of like categories, if you will.
So on a home equity line of credit, and talk a little bit more about that. I mean, that's a scenario where you have, just like you said, you have a credit card. The interest rate, I'm assuming, moves both up and down. Talk a little bit about that.
Yeah, so a line of credit is a line, like a credit line, against your home. And so let's just take a scenario where if somebody wants $20,000 of a line, they have equity in their home, and Texas laws are unique. So it is important to get educated, but fundamentally it's $20,000. But here's the cool part about all the credit lines. If you get a home equity line of credit, also known as a HELOC, right? That's the acronym for it, HELOC, home equity line of credit. The neat part is if there's zero balance, there's zero payment. So it's you only pay interest on what you borrow. So that's one of the neat things. It's interest only, which is neat, but again, people need to understand what that means. And then the last component is what you just said, is the rate can change. It's variable. And then when the Fed, air quotes, the Fed, and our federal government, when they actually change rates, that's the mortgage rate. It actually changes, not the normal, home buying rates, but that's the home equity line. So it's cool. but it's not the end-all be-all. It's not the one-size-fits-all. There's reasons for it, and there's reasons not to do it.
Let me ask you a question. Do you think that it would be a good idea? Let's say you have a family who they're paying down on their home, they're financially in good shape. However, they probably don't have as much of an emergency account as they'd like. Do you think it's a good idea? And I'm sure that your banks don't like this, but is it a good idea to go ahead and open up one for the purpose of having that available credit in case they need it?
I do. Again, it's. I would say that, generically speaking, yes, I think it's a great idea. I personally have done it. I remember getting one back in, I want to say 2016, and it just sat there, never used it, no payments. In 2018, when tornadoes came through the Metroplex, at the time I owned a handful of rental properties, and all of a sudden, insurance covers a lot of what it was, but it doesn't cover other stuff, and it was really nice to have that option. Fortunately, I found a way to make it work, but at the end of the day, it was nice to have that safety net,
right,
to where if I needed the cash. And here's what I'll tell folks: if they're not sure, go ahead and get that line of credit, to your point, for the safety net, because when life happens, job loss or something's going on, chances are a lot of times you cannot qualify for a loan at that time. So if you lose your job, how are you going to qualify for a loan? So to have it in place and have it as an option, get it when times are good and you don't need it, because when you do need it, you're going to need it fast, and the banks may not agree with giving you one.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Talking to Mark Pfeiffer, who is better known as Mortgage Mark, and you can get more information on Mark going to mortgagemark.com. He's here to break down the option of borrowing against your home. Now, one of the loan-to-value ratio is something that's really important in this whole scenario. Talk a little bit about what that is and how that relates to home equity loans.
Yeah, that's a great question, and it's even a better question than you may or may not know, and I think you might know this, but Texas, we are unlike all the other 49 states in the union. Texas has its own cash-out home equity loan laws. So it's under the Texas Constitution. There's an A6. There's an article. It's called A6, right? So for us as mortgage lenders, there are laws we have to follow based on that Constitution, and that says that in Texas, to tap in and get a home equity loan, the loan to value, and I'll explain what that means in a second. The max combined loan to value is 80%. So what that means, let's use really easy math. If a home is worth $100,000. All loans combined, if somebody's getting let's say a second lien or a second mortgage to get a little cash, all combined can't be above $80,000 in that example. 80%, 80,000 total loans divided by the $100,000 value, they can't go above 80%. And Texas did this because it's such a strong homestead state. They're trying to protect us, the consumers and homeowners, from leveraging their house too much to where they lose it. And I understand that principle, but there are really good instances where somebody could use the few extra bucks to make some really good and some impactful changes in their world. But the reality is Texas law says you can't. So it is limited at 80% total loans. So you add up everything that you're going to owe against your house, 80% of your actual value. And that's, again, Texas law. That's not something you're going to get around. But that's a good question.
So, I don't think that I knew that was specific to Texas. So if you go to Arkansas or someplace anywhere,
non-Texas,
it's 100%.
It's not necessarily. No, it's not 100%. It'll be say 85%. I don't know that there might be some second lien lenders out there that may go to 90. So here's the other tweak, and it's not this is the difference when I said at the beginning of the program how there's kind of like two paths: home equity loans and home improvement loans. Again, home improvement loans, you can tap into your equity, but they are not considered home equity loans. So there are programs out there where you can get a second mortgage, and I've seen them up to 100%. And Bob, even not as much today, but I've seen it even where 105%, which makes no sense to me.
That makes no sense.
But you can go get a home improvement loan to go do these home improvements. But I'd say, generically speaking, and I'm making this number up, 90%, because that's what it feels like. The very vast majority, it's going to be a 90% loan to value when it's a home improvement loan. And the thought behind that is you're about to go take 90%, but you're improving the value of the home, which should help, the homeowner, which should help values and all this other stuff. So you can go up to 90% on a home improvement loan, but a home equity, Texas law says 80% is the hard stop.
It's interesting because the way that I look at it, and probably the way someone writing the loan is going to look at it very differently. But to me, if the equity is there in the house and I as a lender have ownership of that in case the person defaults, it would seem that I would maybe evaluate risk a little bit different. But that's really not the case, is it?
No, and again, here, as far as risk, let's kind of answer that in two ways. One, to put a button in the appraise or the loan to value piece. A lot of the folks that are advocating the 80% are going to say that's why Texas has been so protected with all the goofiness, like the mortgage meltdown, et cetera, as people couldn't go leverage themselves to the hill. So that's one piece. But two, go back to the lender's risk and underwriting this stuff. Yeah, again, they're going to look at stuff, and what's interesting is a lot of times, again, home equity loans can be done as one normal first lien mortgage, but in today's world where people are sitting on a 3 or 4% interest rate on their first, the seconds are really prevalent right now in the market for that reason. You don't want to touch 3 or 4%. So if you need that 20 grand or 100 grand or whatever that number is on the backside, it is going to be a different thing, but that's going to require different underwriting because now those lenders, whoever's in second place, if something happens and the homeowner gets foreclosed on, they got to wait for the first lien to get all their money before they get to go back, stand in line, and they get to be second. So it is a different set of criteria just because, again, you're second place. Like you're hoping that you get your money in the event something happens.
Let's talk a little bit about eligibility requirements, from a credit standpoint. What are they looking for, and what do you have to have as a minimum to obtain a home equity loan?
Yeah, so I would say the easy answer is on a first lien mortgage, you're going to look at like a 680 credit score or better. Now, I've seen and we've done loans where I've seen credit scores lower than that, 620, 640, whatever it is. But I would say kind of just a good rough answer is you're looking around that 680 or better. I will tell you when it's a second lien, like those banks I just mentioned where they're going to have to stand in line for their money, a lot of times it may be the 700 or 720. And it's also worth noting that if you're a listener out there right now and you're hearing this and you're like, oh, my scores are whatever your credit scores are because of a monitoring program, the mortgage industry, we have our own way of scoring credit scores, and they're usually 50 to potentially 80, 90 points lower than that of the consumer model, just because our grading scale doesn't go up that high. So if somebody's out there in the world says, man, I got a 750 credit score, they very well may have the 700 or 680 credit score from a mortgage credit score, because that is different than that of the consumer models. So keep that in mind as well.
So in other words, y'all are weighing and looking at different things. And
yes, we put different weight on things. Like we care more about if you pay your mortgage than other stuff, right? Whereas the car industry is going to care more if you pay your auto loan. But in addition to that, like our grading scales, they don't go up. Like if somebody's like, I got a 900, like we don't go up that high. So again, our grading scales just shifted to the left. So our numbers are lower, but it's not lower in the sense that it's worse. It's just a different grading scale. So we don't go up as high as the consumer models.
It's interesting. You never really think about it, but credit scoring is such a huge business.
Oh, massive. And that's, if you're listening now, and I'm going to bunny trail for half a second, just Google, to opt out pre-screen, to get on the do not call list. That's the equivalent of your credit. Because when a consumer gets their credit pulled, if they've not done this, you will get inundated with phone calls because the 3 credit bureaus sell your information. So when you get your credit pulled, it's called trigger leads. Mortgage companies and other just industries can buy information from the credit bureaus directly to say, let me know when anybody pulls a credit report, because we get yelled at, and it's not us. And we pull somebody's credit to help them get pre-qualified or pre-approved for a home, and their phone lights up for the next week with people trying to call them to say, do you want to refinance, do you want to buy, whatever you want to do, because the credit bureaus sell their information. I think it should be illegal, but the reality is it is what it is. So yeah, the credit industry is massive, and there's tons of money in it for sure.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Mark Pfeiffer is with me today. If you want more information on Mark, mortgagemark.com is where you go. So let's talk about a scenario. Let's say, based on your underwriting scale, the consumer has a 680 and overall score. Yet buried in there that somehow that there's a debt default on a credit card. Are you still eligible? I mean, or are there events that an underwriter is going to look at it and go, nah, I don't care if you had a 750, we're not going to write this note.
I'm going to answer that, and I'm going to give my follow-up scenario that kind of mirrors that, but with a different twist. So to answer your question, if somebody's got a credit score, I don't care, pick the number 680, and there's something on there from the past. Most lenders, again, I don't know the exact percentage, but most lenders are going to have some automated process that says the computer's ultimately going to dictate this. They got all their algorithms and formula that says, hey, based on what we see, we do or don't like it. So there's that. There are some local banks, smaller banks, that might be able to make that exception and say, hey, we understand this is from a divorce, or maybe there was a medical issue in the household, something happened. So they might be able to do something about, say, the overwhelming majority is going to have some sort of guidelines and policy in place that are just going to say hard and fast, here's what it is. Second scenario, so let's take the similar scenario. They got a 680 credit score. They're on the bubble. They might be able to get pre-approved. They want $40,000 of cash out to then pay off their credit card debt. Well, maybe without their credit card debt, meaning once the credit cards are paid, maybe their scores shoot up to like an 800, A++, like golden, maybe it's just that debt that's bringing the scores down. Well, it's kind of it stinks, but the reality is it's kind of like a catch-22. It's like the scores will be better once we pay off the debt, but we can't get you the loan until your scores get better. So that's the frustrating part that says, well, if we just give them the money, the scores will shoot up and they're an A++. Never been late on anything, but their credit cards just happen to be towards the maxed out limit because maybe hard times have come, or doesn't matter the reason, but it just stinks to see that opportunity sit there. And if we can't get that approval, the borrower can save hundreds, if not thousands of dollars a month cleaning this up, paying off all that bad kind of debt, the revolving debt, but they can't do it because the scores aren't good, but the scores will be great once that debt's paid off. So that's the frustrating part, and I don't really have a great solution outside if you can get money from somewhere else, 401k loan, or I don't care, mom or dad or somebody, pay that off, let the credit score shoot up, then go get the money and repay wherever you got to repay.
So let's talk a little bit about other non-starters. If you've got obviously a bankruptcy is probably going to be a non-starter.
There's a seasoning, right? You can have one. I mean, everybody's human. So, but if it was last year, yeah, non-starter. If it's been 5-7 years ago, then it's worth at least having the conversation. And I'll tell you, there are, maybe millions, but there's hundreds, if not thousands, hundreds of thousands of banks out there. If you try hard enough, you might be able to find and make an exception somewhere. Just realize if you're outside the box, the rate's going to be way higher. Rates on second liens, so mortgages in general, for a mortgage, first lien mortgage, you're going to pay a little higher. So call it 0.25. I'm making that quarter point higher in rate, maybe. I'm just generically speaking, but a little higher because you're doing a cash out. On a second lien, where if normal rates today are 6.75 or whatever, it wouldn't be uncommon to pay something in the high 7s or low 8s. But if you're now going to something where it's like you're making outside that box, I've seen and heard of rates, we don't do them, but I've heard of rates being 9, 10, 11, 12% on that second. But if you're paying 28% on a credit card,
right,
that might be a better alternative. It's hard to know.
I think the other thing too that it kind of complicates this is that I wonder if most consumers or homeowners really know how or realize that they have so much equity built up in their house.
We have the most equity ever. Like there's over $1 trillion of home equity in America because COVID shot prices up so much, and it stinks if you're trying to buy a home. But boy, anybody that's owned a home in the last handful of years is rich on paper because their home values have shot up. So I believe that you're right, Bob. People just don't understand like how much is there. And I implore anybody, if you even have thoughts, talk to somebody, get a mortgage lender you know, like, and trust, and talk them just about your options. It may or may not be the right option, but you're right. It's a fantastic tool, and they may not even know they have it. So I would say if there's debt to pay off, remodel, just anything big, or even just a business owner or somebody who wants a rainy day, option for them, I think it's a massive opportunity to at least explore.
But I would also say, add to that, it's important to be intentional about what you borrow. Don't
100%.
over borrow because you may use the money to put down on a more expensive car or something like that. I mean, this is
the one moral thing, and I always, we've known each other for 15, 20 years, Bob. It's one of those, but the one thing I don't feel good about, because the customer's always right, and we do our best to coach and counsel, but sometimes they don't always go with that counsel. Much to my chagrin, I don't like that, but it's when somebody is going to take the money and just go back and do it again. I've done early in my career. I helped somebody get a loan to pay off $70,000 of credit card debt. 3 years later, called me up, wanted another cash out to pay off another $70,000 of debt, credit card debt. And it's hard to, I'm like, man, and it's one of those, you struggle as a person to say, man, I don't love this, but what am I going to, because it does help them, but I know that their habits are just going to be there. So yeah, intentionality, having a plan, and most importantly, executing that plan is so important when you do something like that.
Once again, the website is mortgagemark.com. Mark, always a pleasure to have you on the program. We'll talk with you next month.
Always a pleasure to be here, Bob. Thank you.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. I tell you, I want to drive that point home maybe not now. That's the music. But be intentional about taking money out against your home. You want to make sure you have a good game plan and you're not over borrowing. Well, if you have a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.